Good morning, everybody. Thanks very much for joining us. We've got a super panel here today. Thanks very much to all of the team as well at Schroders for hosting in this amazing venue, which is fantastic. Thank you all for joining us on a rainy Thursday morning. We're going to look a little bit at some of the key trends that we're seeing, how that's going to be influencing the real estate markets, and also take a look at some of the other geographical markets. And it's designed to be an open forum, so if you've got questions, things you want to contribute, please do. The idea is it's here for us, and of course we will then write that up and share it with the audience in Cannes for MIPIM in the next issue of the magazine. For those who don't know me, my name's Richard Betts. I'm the publisher and head of content at Real Asset Media. This is what we'll be doing today. So we're going to have a presentation from Oliver. Then that will give us some, I guess, a platform to dive off into some of the conversations around what we're seeing in the market. And then we will finish on time at 10 o'clock, but there is time for coffee and networking and to ask any questions you didn't want to ask in public. The speakers will be still here, so you can ask it then. For those who don't know Real Asset Media, we publish a flagship magazine called Real Asset Insight. We also, and in fact there's copies of the latest one. I brought it from Warsaw because I was in Warsaw where it is printed about 4 days ago. So there are copies of the CEO Outlook is there. We also publish Living Retail. Real FDI is a new one which focuses on the crossover between institutional investment, private capital, and the investment promotion agencies, so countries, cities, regions, to try to bridge the gap there in terms of knowledge and connection. And we also launched 2 years ago Real Asset Impact, which looks at ESG, social impact strategies, purpose-driven investment around the built environment. If you're at Expo Real, we also run the International Investors Lounge and Expo Day, which is the daily news there. And we try to be collaborative as much as possible. So we'll have sessions at Transport Logistics, MIPIM, those kinds of things, sharing really insight, strategy and research across the market. And we also fell into running the Senior Housing and Healthcare Association as well. So if you're interested in any of those, do contact me. And we are now going to have, because we are all in here in person, we can welcome Oliver here to give us a presentation. Welcome, Ollie.
Thanks very much. Thank you very much, Richard, and welcome here to Schroders. Glad you could be all here this morning. Glad to be here in person. I just really want to set sort of the scene this morning with some observations on the current state of the market. I think it is easy to be a little bit pessimistic at the moment, maybe even when you see the weather outside. But I think I just wanted to highlight a bit that we really believe here at Schroders, for example, that there is a window of opportunity for real estate investment opening. So actually, it's exciting times. Well, if you look at the world at the moment, I think it's fair to say that the current outlook remains very much characterized sort of by a lot of volatility and uncertainty. Inflation, or rather the fight against inflation, remains still a very big topic. And with that, of course, sort of the thinking about the future path of interest rates. At the same time, there's still a war going on in Ukraine, with questions being asked on, how, if or when this conflict will be resolved. Will the US continue to support Ukraine? Will the Europeans step in? Will Europe start investing heavily in its military capabilities? You have a conflict in the Middle East going on, Israel and Hamas, which is escalating, could spread into the region. Have Houthi rebels involved, attacking ships going through the Red Sea. And then, of course, there's climate change happening. And in the event of a further major drought or natural disaster, it can have quite strong impact on regional economies as well as on the movement of people when you think about migration. People have been flagging that El Niño, the weather phenomenon, is back, which could have an impact on food security. This year is the super election year. We have, I think, elections coming up in more than 70 nations in the world. So by the end of the year, we could be we could wake up in a very different world. We have presidential elections in Russia. Well, I wonder who's that going to win. But more uncertainty is probably around who's going to win the next US elections. We have elections in the European Union, which will give us a quite interesting impression or feel for where the far right sits and what kind of policies that would bring. And you could, of course, ask, well, what does it mean for me? Like, why should I be concerned about that when we talk about real estate investments? Well, because, of course, it has major implications for, the path of inflation, interest rates, government bonds, the price of commodities, earnings of companies, government spending, and so on and so on. So it is pretty relevant. And I think, what we're seeing at the moment will just ensure that over the next few months, it will continue to be quite loud. You will see a lot of noise. And I think as real estate investors, we need to be aware of that, but we also need to sort of, focus on our fundamentals. But it will be difficult to make predictions, and I think uncertainty and volatility will be with us for a few more months. The good news is, inflation seems to be under control. Eurozone inflation in January was 2.4%, which is definitely coming close to the ECB's policy target. It remains still elevated, which is down mostly to core inflation, which has proven a little bit sticky because there's still sort of wage growth. It is declining, but it is still there in the system. And there are upsides risks to inflation still, I'd say. When you think about geopolitics, when you think about food prices, flow of trade, energy prices. So I had a chat with our chief economist here, and he says it's majorly about oil prices. He doesn't see any issues about gas, really. But if the oil price sort of starts spiking, that could have a major effect. And what we can see already is, of course, that a prolonged period of high inflation and high rates has had a big impact on consumers and on businesses. And the economic momentum in the Eurozone really remains fairly weak. But again, if you want to take a little bit more of a positive outlook, there are still hard yards in front of us, to work through over the next months. But at least, it looks like growth will be returning towards the end of the year. Yeah, and in the fight against inflation, central banks have raised interest rates very significantly. You're well aware of that. But what is noticeable now is that these sort of constant increases have stopped. Rates have been stable for a number of months now. And I think, it is likely that we have reached a peak now. As I said, central banks remain fairly concerned about inflation. They have been given a lot of criticism for not reacting quick enough to tame inflation. I think now they want to really make sure that inflation is off the system. But what I found interesting when I read the minutes and the statements from the ECB from the last meeting is that they had actually removed this passage about sustained domestic price pressures and labor costs from the statement. So it looks like the ECB is also moving sort of into a more, I think what they call data-driven mode. And yes, markets are betting on rate cuts. We can see, it has started to filter through into bond markets. Government bonds have come down, which I think, is good news for real estate investors. So what do the markets think? The question is, when will these cuts that the markets are betting on happen? Well, this is how the futures market is looking at it. So, if on the right-hand side, you have the rates in the top column, and then the meeting dates for the monetary policy committees on the left, going down. And you can sort of see that the most likely reaction. Again, this is what what futures markets are betting on, showing us. You can sort of see that for the March meeting, there is quite a high percentage of market participants that believe that rates will be stable. This is from a week ago. I've checked it this morning. It's still sort of around 90% for stable rates in March. And for April at the moment, it has moved a little bit. So this is more 50-50, right? At the moment, it's more like 40-60. So there seems to be like a slight move in market sentiment that rates might be stable as well for the April session. But then afterwards, we are back to a sort of 80-20 for cuts. Now, of course, these kind of things are quite volatile. So at the moment some new data comes out on economic growth, on inflation, anything really, consumer spending and so on, you can see sort of movements in these probabilities. So if you have a chance, you can have a look at it this afternoon, because I think at lunchtime we'll see the new Eurozone inflation numbers being published. So it will be interesting sort of to see what that means. But again, like these individual movements, fine, let that happen. But it looks like, markets are betting that we will see cuts sort of around June or July. What does it mean for real estate and real estate prices and yields? Well, for the moment, yields remain actually on the move. Yields have been moving over the last few months, still outwards. But there is more stability over the last months and towards the end of last year. What I find really staggering is, of course, sort of to see the magnitude of the outward movements, which has, of course, hit offices and logistics, two asset classes which had, very, very low yields before interest rates started to jump up. Retail, a little bit less affected, there you already had sort of the impact from the pandemic, and I think in 14, 15 already you could see sort of people getting quite concerned about e-commerce and so on and so on. Yeah, looking at the investment markets, again, this is also no surprise to you. Activity in Q4 has also been very low, and transaction activity remains very muted. I do think there are opportunities in the market, and they are starting to emerge, but what you can really see is very often sort of a quite big spread between bid and ask. Yeah, so buyers and sellers not getting together, not being able to agree on the pricing, and in many cases, I think that's also because the valuations haven't moved sort of in line with these current market pricing. I don't want to get into debate about German valuation versus mark to market. There is something in here, and I'm going to come to sort of that a little bit later when we talk about sort of which markets might see sort of the first movement, or which markets sort of see liquidity coming back the quickest. JLL, the brokerage company, they have something called like a bid intensity indicator, which I found quite interesting. And if you look at that one, you could really see sort of towards the end of the year how that bid intensity on a lot of opportunities, mostly living and logistics, actually started to turn up. So again, I think that's a very very positive sign. What I do think, though, is that over the next few months we will still see quite a bit of price discovery. I think that will just remain a feature of the market. At the moment, I think we haven't seen a lot of distressed sales. Something maybe we can discuss on the panel as well, because there is clearly a big funding gap in the market, particularly in Germany. So I'm quite interested to hear what Rogier has to say about sort of lending and what he is willing to lend against, and where sort of he sees the markets moving with this funding gap. Right, let me come to the opportunity. If you look at these kind of indicators, very clear that European transaction pricing has shown significant corrections, really significant corrections. I'm using Green Street's commercial property pricing index here, and it's down sort of 36% for offices, 23% for industrial and residential. Behind those, obviously, you have a range. There are markets where the values have even fallen a lot further, and some where it hasn't been that dramatic. But again, with inflation stabilizing, with rate cuts on the horizon, I think we are sort of in a phase of the market where market pricing is stabilizing. What I think is also very encouraging is when we look at the occupier markets. So we have a demand side which is very much impacted by sort of very low economic growth. But what is really helping the occupier markets at the moment is the supply side. If you take offices, for example, you can really see sort of how vacancy rates in Europe have actually remained fairly moderate. During the pandemic, not a lot of new schemes have been started. In the last year or year and a half, obviously, lending against sort of real estate has been very low. Construction prices have been high. And what that means is basically that after this year, the supply is really, really going to fall. And that is really supporting sort of the markets here, despite a very, a very lackluster sort of situation on the demand side. There's also a lot of things going on behind these rental forecasts. There's structural change happening. I'm sure when we're going to talk about sort of the logistics sector or even offices, we can sort of point to structural changes that drive some of these rental growth. But again, I find it really encouraging, that the occupier markets sort of show this robustness and sort of actually will help us to maintain income, if not even grow income going forward. If we bring it all together, we believe that in many segments of European real estate, we see actually better value or even fair value. What you see here in this model is really sort of like a sort of side where you have a required return, which would be your 10-year bond yield plus a risk premium, which varies by market. And then you have your available or prospective return in the market, which would basically be your net initial yield plus your income growth minus a bit of an allowance for capex. So where the bar is higher than the line, this would actually suggest that there is sort of fair value to be had. And obviously, it's very general, individual market conditions, and so on and so on. What it helps us here, and why we're doing this exercise, it at least sort of gives us an idea, sort of, in which part of the market we should be looking, or where the probability or the chance of finding fair value is higher, and which sectors we should probably overweight or rather underweight. Another interesting thing, which I think can be easily forgotten if you are in a period where the market is not moving, where sort of yields are moving out, where values are under pressure, is really that investing after an economic downturn in the past or after big market corrections has actually delivered above average returns. I mean, nobody wants to catch a falling knife, of course, but at the same time, I'm wondering if there's a little bit of like FOMO, or there's sort of fear of missing out, and if that's going to kick in, the moment you see a first mover in the market, who says like, right, I think this correction is over, this is the bottom of the market, calls it and goes out. And again, if you look at the past, people or investors who, invested after the global financial crisis or, after the dot-com bubble actually, sort of have been able to reap in quite some nice returns. So yeah, it is easy to forget, that sort of like a downturn and a huge correction is also a phase or a time for opportunity. We also think that this will be a sequential opportunity. I think in Europe, the UK, the Netherlands, and probably parts of the Nordics are the most advanced when it comes to the correction. In the UK in particular, we think that's because actually the correction started already with the mini budget, right? When the bond yields were sort of like blown out of the water, and sort of that filtered through into the real estate market and real estate pricing. So I'm pretty sure when we discuss sort of the UK market later on, that will play a role as well. What do we like? This is going a little bit more into sort of themes. As you can see here, there's a lot about living. There's a lot about sort of logistics. There's a lot about alternatives. Alternatives. Question is, how alternative are they still? But if you look, for example, at the composition of the UK MSCI index, I think this part, which is others or alternatives, is now 30% of the index. So clearly there's a lot going on there, and I think there are some really interesting strategies in there. Some of them are a little bit more operational, where you need a partner, where you need to understand the business model. But I think if you get that right, you can have some really decent sort of long-term returns coming out here. I haven't gone too much into sort of individual sectors here, and I think we can do that on the panel. I think a lot of people give offices sort of a bad rep, and I think a lot of what's happening in the US is sort of giving offices in Europe a bad rep. We still think there is a place for offices in a portfolio. It's just what kind of offices, should those be and where should they be located. So if you bring that then together, this is where we sort of would position ourselves when it comes to sort of lower allocations or sort of like higher allocations. But I hope that sets a little bit sort of the scene for discussion. And Richard, I think we are ready to dive into some of the burning questions.
Great, thanks very much. Ollie, thank you.
Please read all this.
Yeah, but no, I've thoroughly read all of that. That's great. Good. Super. Your work here is not done, Ollie, so take a seat. If the speakers could come up, that would be great. And Rogier, you're on the end and everybody else can sort themselves out. That's great. It's your office, Ollie, so that's
Yes.
fine. I'm glad it wasn't me. Great, thanks very much. Let's start just with some quick introductions. Maybe, Ollie, just for you, just a brief introduction of what you do here, which you didn't necessarily say in the start of that, and then we'll work our way down just briefly. Ollie.
Yes, yeah, hi. So I'm the head of European real estate research. So in my position, I sort of cover all European markets and all segments. My job really here is to sort of help in the investment managers, the fund managers, the asset managers, sort of to make sense of what's going on in the market and to help develop our investment strategy. As I said, with some of these models, trying to sort of guide our investment philosophy in where should we be investing, what should we be investing in, how should we invest in it.
Perfect, thank you. Mathilde.
So I'm Mathilde Guittard. I work for Octopus Real Estate as a senior investment manager. I focus on senior housing and I work on the transaction side. In the UK, we look mostly at the sale model, but we're looking at also Europe as well, and we're looking also into the rental senior housing, which is very close to my heart.
Great, thank you. Miles.
My name is Miles Skinner. I head up investment management at Union Investment Real Estate, covering the UK and Ireland markets. For us, Ireland is Dublin, and then in a UK context, it's London and the major regional cities. My predominant focus is on the office and residential sectors, and in residential, we're more narrowly defined as multifamily, BTR, as a focal point.
Great, Nick.
Hi, I'm Nick Preston from Panattoni Investment Management. I joined Panattoni Group very recently to set up the Panattoni Investment Management platform, which is a new thing for the Panattoni Group. For those of you who don't know, we develop logistics all over Europe, the biggest logistics developer. So this is a new step for the group to develop the investment management side.
Great, thanks. Rogier.
I'm Rogier Bos. I'm heading the Benelux office of Berlin Hub. We are lending in Germany, of course, Poland, France, and the Benelux, focusing on all core asset classes.
Great. Let's start with you, Rogier, as well. Just in terms of some of the macro things we talked about there in the presentation. I guess, what's your take on that? I suppose when you're looking at interest rates, you've got to make financing decisions there as a bank. So I suppose, what are you putting into your view when you're looking at the outlook?
It was quite an interesting presentation, by the way. Thank you. I was, and you could also see that our interest expectations are shifting a little bit, and I think quite a few people are underestimating the importance of the inflation reduction by central banks. So what I've sensed over the past couple of months, that people are basically anticipating on rate reductions, waiting with investment, waiting with borrowing also, and actually thinking that it should go back to the situation where we have been 2 years ago, and that is not going to happen. We will not go back to the zero interest environment that we have seen, and central banks will only go down when they are really sure that inflation has been taken care of. And I think that is a very important point. That's one thing. The second thing is, of course, that valuations are usually going up later than interest rates go down. So there's an interesting delaying effect in there. So yes, we are actually positive towards the end of the year. The question actually is when the end of the year will be starting.
Okay, good. And just in terms of the panel here, we've obviously got expertise and insights which are across Europe, but also some that are going to be focused around particularly the UK market. And obviously logistics and living are two of the big areas that are of interest at the moment to investors. So we'll do a little bit of a deep dive into some of those as well. But Nick, maybe just coming to you in terms of the sort of macro trends, I guess pick up on what we're seeing generally across the market, and then maybe drill down a little bit into some of the trends that you're seeing, particularly driving logistics.
Yeah, the logistics market is still very well set, and all the points Roger is making about the interest rates is really important, but put that to one side, and I agree, when it happens in terms of the interest rates coming down, but people are much more confident, I think, that we're through the worst, and therefore are looking more positively. And then you're looking at the logistics market going, well, actually, fundamentally, an awful lot of it is still in very good shape, as it has been for the last 5-10 years. And by that, I mean the land supply issues that we're seeing, huge pressures across Europe in terms of constraint on land supply. That's ever growing. I speak to all our teams across Europe, and the only thing that they are worrying about is where their plots of land are coming from to develop the next site. And so that is one part. Then you look at the other part, which is the occupier demand. And again, that is strengthened. And Ollie was mentioning all of these pressures that we're seeing. You know, the consumers, the wealth in Western Europe, which is what these logistics buildings service, fundamentally, whether it's through manufacturing, through consumers, etc. That demand is still good. We're seeing in Eastern Europe the reshoring. A lot of that is happening now. The Far Eastern manufacturing is now coming back to CEE, where the labour costs are cheap and flexible, and where it's that proximity, that supply chain security, being close to the consumers, the ultimate end users, all over Europe, but Western Europe in particular, that is leading to demand.
There's an element of globalization, I think, what a lot of people refer to, right? Yeah. Where that goes back to your point about supply chain security, where people just say like, well, is it really still viable to produce in a certain country in Asia? Okay, we might have a cost advantage, but
that cost advantage has narrowed massively from, say, 30 years ago, if you want to pluck a number out of the hat, in terms of when that was originally the case. That differential has narrowed massively, and the insecurity piece has gone up substantially. And therefore, and I was in Poland the other day, they're all talking about this, there are microchip manufacturers coming over from the Far East, all of this type of thing. And these are huge plants. We're reading about Chinese car manufacturers coming to Hungary and this type of thing. There's lots happening. And it's not only those enormous manufacturing plants, it's all the subcontractors and suppliers that come into that. And all of those are driving these economies.
Yeah, there's definitely a huge change there. It would be good to pick up, Miles, just obviously looking at the UK, because you're head of UK and Ireland for Union Investment. It would be good to pick up on some of the more kind of pan-European trends that Ollie was talking about. And I guess, how do you see those, particularly when you're looking at the markets both here and in Ireland?
I think it's very interesting because in 2022 we had 2 leadership contests, we had 3 prime ministers, 4 chancellors. It was all a bit of a disaster. So from the outside looking in, it was quite a complex picture. The mini budget derailed a number of us with our investment decisions. We unfortunately had to withdraw from one particular London residential transaction. And we were then trying to just muddy our way through high inflation, high interest rates. For euro-denominated investors, we've faced very volatile hedging costs. And in normal market circumstances, we might look to offset those hedging costs on our equity by using accretive local finance. With interest rates so high and debt so expensive, that hasn't been possible. So fundamentally, it's been a real challenge for us in a UK context to hit required returns. I think we're also finding that German open-ended funds have gone from a period where inflows were significant, steady, and pretty regular. And there is a lot more pressure now on core funds to return higher to our investors on the basis that the alternative investment universe is pretty strong. But that said, I think would agree with Oliver that there are certainly opportunities to come this year, but there's more cautious optimism in the air, I would say. Generally, at Union Investment, our funds are underweight to the UK market, which is a real positive. And in part, that was the thinking behind setting up our local London office, which was fairly recent, back in April 2022. So we're only 2 years in the making, but a sense that we could capitalise on opportunity. And again, back to one of the slides in Oliver's presentation, yields never dramatically dropped to the levels that we saw in continental Europe, in the UK. So whereas in Berlin, Munich, Frankfurt, Paris, we were seeing yields dropped into the 3s, we never quite got there in the UK. So we're starting from a higher base, and there has been a faster price correction. And that price-adjusted position should yield quite good opportunity for us this year, I think.
Okay, good. And Mathilde, it'd be interesting to pick up on you. Obviously, one of the things that Oliver mentioned there in the presentation was even with my eyesight, I could see senior living there as an opportunity. So it'd be good just to pick up with you, I guess, what you're seeing, particularly in the UK market, but also any insights that you've got in terms of the comparative with continental Europe and how you're seeing those.
Yeah, so I think like if we're focusing on the trends, one of the things that we've seen in 2023 is probably like a huge correction in terms of land pricing. So we had a couple of transactions. We usually are pretty good at keeping our pricing. However, like when you have so much volatility in terms of interest rates, we had to adjust pricing. Also, people were asking land price in 2022. They had to adjust that. On prime location, this hasn't been necessarily true. However, planning is still very challenging in the UK. So it's still like something that has affected the pricing. I think that's one thing. A second thing I would say is on the senior housing side, it's a very resilient asset. In the UK, it's mostly a build-to-sell model, and most of our customers are buying cash, so they haven't been affected in the same way as other customers, but higher mortgage costs. However, they have been affected in a different way in the sense that they are part of a chain, and therefore it has slowed down like the level of completion in terms of our sales pace. However, we haven't seen any correction in terms of sales pricing in our sector. I think in terms of like a third thing, I think like one of the things that we see is a common theme that is crossing around the UK and Europe, which is, well, we all have more or less a house crisis. We all have an aging population. I think like the numbers are that 1 in 4 Europeans in 2035 is going to be above 65. So we need to adjust for that. And we need to build like accommodation for this and make sure that they're not boring. And I think that's one of the things that we liked about in the sector is try to make like senior living fun and sexy and all of these words. And we've seen like very different way to do it across Europe. In Denmark, we've seen like timber, very ESG focused, atriums in there for like 60, 70 people. They have so much demand that they're selecting their customers. In France, you have Domitis, that is a very, very, very strong operator. They have over 150 buildings, and it's filled up very, very quickly. So I think like we're trying to adjust for that, and obviously like in the UK, we are partner with Audley and Elysian. And I always tell that story that I dragged my own partner on a Saturday to a senior living. He wasn't very happy, but after he's seen it, he was like, when are we moving in? So that's kind of the trend that we're seeing in the market. And we think there will be a lot of opportunities to partner with new people. And we still have seen the value add rate maintain. However, we have had to reduce a little bit our leverage considering the cost of debt.
Well, that's an interesting point as well. Like we talk about sort of the market movement and sort of like how the yields pay out and when the interest rates are where. It's all very important. It's important to get your entry point right, and it does affect the valuation. But trends that Mathilde mentioned. We spoke about deglobalization. Those kind of things. Those basically that play out over the next 5 to 10 years. Where real estate, is a long-term asset, well, should at least be, or is perceived as that. So these kind of trends, play out so much more to the success of a successful investment than maybe sort of like like getting the pricing by 5 or 10 basis points wrong or something like that. So I think we need to sometimes remind ourselves that it's the long-term trends, urbanization, deglobalization, demographics, and so on that really are sort of drivers of long-term success in real estate investment.
Yeah, no, I think that's interesting. Rogier, I just want to come to you on the financing side, and then I'll be interested to see what everybody else's views or experience on that is at the moment. But what's your take both? I mean, Oliver mentioned the debt gap, and obviously we've all probably seen the research from AEW on those kinds of things and other research as well. But what's your take on that? And I suppose as a bank, how are you having to adjust to the situation at the moment, really?
Yeah, it's interesting that you call it a debt gap. I think Oliver called it a funding gap, and I would call it an equity gap, actually. What we see, there is finance available. Let's start with that. It's of course a matter of quality. It's about the assets, and especially in circumstances like this, it's like the previous crisis. You can make a distinction by basically buying and investing in good quality, and there is no credit case in the meanwhile in our committees anymore, which is where ESG compliance is not discussed. So of course it doesn't have to be sustainable. It might have to become sustainable. We're talking about transformation of properties. There's financing available for all of that, but it's more a quality issue and it's an equity issue, because LTV has not really reduced. Perhaps a bit. The atmosphere is of course a bit more conservative than it has been 2 years ago, but when the asset is right and the price is right, then debt is available, and there haven't been a lot of banks closing their shops yet. Of course, we are the largest in the Netherlands. We are the largest non-domestic player, and that obviously means that quite a few clients of Dutch banks come to us. At the moment, of course, they have a lot of questions about financing of offices. And yes, we are open for financing offices. Of course, we are critical in what we are doing, but there is certainly a demand for offices in the future as well. Learning also from, let's say, the global financial crisis, we've been focusing on the top 20% of office buildings in the markets, and that have proven to be a good investment, and I wouldn't see why that would change in the coming 10, 20 years.
And you mentioned there that there's an equity gap. Do you see, and Oliver mentioned in the presentation as well, and we've all seen it, the gap between buyers' expectations and sellers' expectations. You've got a European overview there, Rogier, as well. But, just in terms of the Dutch market you mentioned there, are you seeing that gap closing, or is it still kind of a standoff?
The gap is still there, but it's indeed closing. What is very interesting to see is that there are quite a few entrepreneurs collecting equity to step in and buy at a bargain. And actually, I feel that quite a few of our clients would like to be prices a little bit lower in order to step in. Actually, when you compare it to the previous crisis, the prices are in that respect not low enough. And if the market picks up rapidly, this would mean that they have to accept lower yields, which could mean that equity might not be as interested anymore as they may have expected a couple of months ago. So there's a lot of equity interested to step in, but yield expectations are probably higher than they can actually achieve.
Yeah, I think you're absolutely right when you look at sort of the data that comes out of Preqin, for example. I think a lot of money has been raised in 2020, 2021, 2022. That money hasn't really been spent, and if you look at sort of what is sort of like declared as dry powder, I think there's a lot of money sitting on the sidelines just waiting to get in again.
Yeah.
And it'd be interesting to get everybody else's perspective on that, both the financing side, what the challenges are there, particularly I think around the development area would be interesting. So I don't know if anyone else has got a kind of take on that.
Maybe just from my side, and I was actually just last night talking to some UK Southeast the development team at Panattoni, and I was asking exactly this question about this gap of are the vendors starting to be more realistic, and there's this combined thing. There is a gap, of course there is, but I do sense that it's narrowing. It's narrowing from both sides. The land sellers in this case are becoming more realistic. They have to drop their prices. We're not where we were 2.5, 3 years ago. But also the buyer, the investors, are becoming more positive because of the macro piece and also the logistics bit. So I do sense that it's closing, the gap. And talking to the guys last night, they were saying, yes, there are deals now starting to actually happen again with far greater frequency than we saw last year, where and Ollie's numbers showed it, there's a big drop-off in transactions. For this reason, that gap was huge. That gap's now really quite narrow. That's in the UK, Southeast UK, which is probably the vanguard, if you like, of the market in Europe. And I think we'll see, as we've seen before, that will then cascade around Europe and in the usual way, probably across the channel into Netherlands and Germany, Nordics, France, and then push out south and east, as we've seen before. And so I do think we are starting to see things pick up again, and we'll be a bit more positive about things.
Okay.
I think it's dependent, though, on the segment of the market that we might be operating in. In the core space, we're finding it very challenging to source appropriate investment opportunities, because largely speaking, where we find assets which are well located in core CBD areas that fulfill our ESG credentials, which are becoming more and more stringent, that sort of product is not really under distress. So owners of those assets aren't necessarily needing to sell at this point in time. And frankly, why would you look to sell when there is so much uncertainty, a lack of liquidity, and probably lack of depth of buyer? But I think in the value add space, there is probably a little bit more opportunity because that distress is starting to creep through with the funding gap. So I do think it is very dependent, and also very dependent on markets as well as sectors.
I think what has helped the UK, though, is the fact that not just has the correction started earlier, but unfortunately you also had some distress sort of with funds having redemptions and having to sell, and I think that created liquidity and price points on top of the fact that obviously, in this part of the world you do much more for mark-to-market valuation. So I think that is really, again, I'm not trying to sell the UK here, but I think it is sort of like a market where the correction has advanced the most for these reasons.
Agreed, yes.
And we definitely have seen that in the UK, and being in the value add space, we have seen way more opportunities. Actually, for us, 2023 was the most busy year in terms of transaction. We closed 5 transactions last year and invested 200 million of equity. So it was a very, very busy year because of that specific fact that there wasn't so much potential buyer in the market, and we had the ability to negotiate a bit more, and we had long-term relationship with our partners. Obviously, the UK have seen quite a bit of correction. Where we haven't seen that correction is, for example, in Germany. We looked at the market quite strongly. We tried to find partners, and there is still a huge gap between the level of regulation, ESG constraints, financing constraints, and pricing. So we haven't yet cracked the market. I feel like everybody's kind of waiting on what's going to happen. I think some people think there's going to be no correction. We're probably of the opinion there will be. Spain, in that regard, is quite an interesting market for us. There is a lot of value-add opportunities there, and we're looking at it quite strongly. And I think Ireland as well is an interesting market. We have found a lot of debt opportunities because on top of being a landlord, we're also a lender. But to go back to the point, we haven't seen a lack of debt availability in the markets. Actually, I think we have never seen so many people ready to lend us. I think it's just the pricing is pretty high. And then obviously in some markets it still makes sense, but we have reduced our leverage to take into account for that, just in case the market was bad.
You're in the right sector, Mathilde, right? This is why, the banks would open their checkbook and, the investors are after it. So,
It would be interesting to I'm going to come to offices in a minute, but I just wanted to pick up on the point around capital and what we're seeing, both in terms of capital coming into the UK, but also I guess it'd be interesting to pick up from your views from a union perspective, I guess, on what German capital is also looking at across Europe. So I don't know whether anybody wants to pick up what's happening on the capital front, where you're seeing investment, whether US investors are in or out, whether Asian investors, Middle Eastern investors, who's kind of looking at the UK and broader European markets? Yeah, feel free to
take
kick off.
that one. I'm quite live on that at the moment in terms of trying to launch an investment management business and talking to a lot of investors. Admittedly, We're in logistics, which is the hot sector, which is still, I think, relative to others, obviously with some of the others like the living and such alike, are up there as popular. But the answer, Richard, is everywhere. We're seeing North American investors, we're seeing European investors. There's traction from the Far East. They generally tend to move more slowly. Australia, Middle East, there's all over. There is still the desire to invest. Yes, they're picky about sectors. Yes, they're picky about everything. But there's consistent, interest.
So no lack of capital, just slightly on the sidelines at the moment, I guess.
There's been a lot of people, as somebody referred to earlier on, there's a lot of people who raised equity, who've been very cautious over the last couple of years, for obvious reasons, who are, keen to invest. And in my previous role on the listed side, it was the same. There were an awful lot of equity investors out there with money to invest, who were just sitting there waiting and saying, oh, the market's too hot, it's too this, it's too that. But there's plenty of money out there. The prospects are better, the fundamentals are now better. So I do think, I'm reasonably confident that that side of things will, continue to do quite well.
Okay, good. Mars, it'd be interesting to pick up the view from, I guess, German capital in the sense of union. We had there was a session that I was at a month ago for EPRA, actually, where Morgan Stanley there said that for the first time in, I think, 6 or 7 years, they were going to be weighting the UK to where it should be, whereas they'd been underweight for the last 6 years. But now they feel that there's more stability so that they can see where the investment is potentially going to be. But it'd be interesting to get that perspective from you, Mars, as well.
There was an extraordinary statistic before I joined Union and the London office that there was a greater investment from Union into the Polish market than there was in the UK, which I found extraordinary because we have a global portfolio and naturally you would expect that London would sit fairly well within that. And there's definitely a move towards coming into the UK, price-adjusted market and opportunity. But there is still a lot of caution. The funds have been conservative, looking to build up liquidity levels, build up their cash positions, particularly because of some of the domestic challenges in Germany. And it's trying to be selective as to where those opportunities lie. And that mood really does vary between the different funds, depending on the strength that they're in. All of the funds will not take a view on the performance and returns of an individual deal. Perhaps in the past, there was a mood whereby a London office deal presented lower risk than a logistics deal in Eastern Europe, and therefore returns could be slightly lower. I think now, because core funds are under pressure to show a higher return level, they do want to find individual deals that meet those returns. And in the UK context, that's tough with the financial dynamics I mentioned previously with hedging and financing. And I think in continental Europe, not just in the office sector necessarily, but more widely, there just hasn't been that same level of pricing correction. And to pick up one of Oliver's themes, for a German business which has a German valuation system, there are intricacies that need to be managed, and it can be quite complex as to how valuations are looked upon. But our funds value on a quarterly basis. And when I think of what's happened in a London office context with some of the international capital that has come in and invested, whereby that capital has an annual valuation cycle, it's much easier to ride out this period of volatility. Whereas for us at Union Investment, valuing quarterly, there is certainly pressure on quarterly valuations, what's coming up next, and is now the right time to buy, or if we buy now, despite our long-term horizons, looking at a hypothetical 10-year hold period, and often holding far beyond that, will we see a downward movement in valuation in the short term, which will bring about adverse impact on performance, and that will then hit fund and strategy. So it's quite a complex situation, and while we do have cautious optimism for the year ahead, we're just not quite there yet, I don't think.
Okay, good. And Mathilde, from your side, are you seeing particular types of capital looking at the sector?
So I think we have a bit, I think just to step back a little bit, I think real estate is a bit of a change asset class now, simply because, frankly, like the bond market is back. You have your returns on the equity side. So, you know, like for people to go into real estate like before, to get sometimes lower return than what they can get on the bond market, it doesn't make sense. So we need to adjust to that. And in all fairness, that impacting the core market first. So it's way more challenging. So obviously, like that has pushed, like, you know, like a bit of more pressure on the value add sectors, and that's different type of capital that are looking at value add. Let's be honest. I think we have a bit of a more like divisive view on, you know, like how like different geography looks at it. In Dubai, for example, and all the Middle East capital, and generally speaking, there is interest by sector, but there's interest to have control of the operating platform. So, you know, like vertically integrated fund is quite trendy at the moment from the Middle East. In the US as well, this is something that we are seeing with people like Blackstone or BlackRock in terms of capital allocation. I think there is a different type of like view from Asia that has seen that like the markets in Europe are probably at a good time in terms of pricing. So we have seen a little bit more Asian capital coming back, but a different view. On the Middle East, it's a bit of a divisive view, just to come back to that, where like they can see like their own return in the market, just because there is a lot of Russian investment coming in their own market, so they have higher expectation again of returns. So that's kind of what we are seeing. Like the investor that are still very, very keen for us is obviously like people like from the UK actually that can see the opportunity in the UK, and we have like you know, really good partnership with pension funds and have been able to extend our equity commitments. We're looking obviously at doing rental senior living in the UK and Europe, because we think there is a huge opportunity, and we think it's going to be a mix of this different type of investor looking at it in the sector.
Okay, good. I wanted to pick up a little bit on the office and the broader residential side. So, Oliver, you had a more positive view on office, and I'll be interested to see what the other views are. How do you see that? I mean, you mentioned obviously it's a different situation here to the US, and I think we all would agree with that.
Do we? Because, you know, often...
Well, I hope
we do,
question.
But, you know, very often I get this like, yeah, but the office is dead, the office is not there anymore. And you go like, it's not. I don't know where you get this view from. I mean, of course, you know, and you mentioned that actually very early, Rogier. Of course, the office market has changed, and it's a market that's extremely polarized between, you know, the best and the rest. But the office still has a function for companies to play. Companies value the office. I mean, there's a reason that, you know, we have this office. You know, it's about bringing people together, driving collaboration. It's a part of the brand of company culture. It's a place for learning, for meeting, and so on. But it has to be in the right place and at the right quality. And I think the huge difference that I see between what's happening in Europe and US is that in Europe, I think our occupancy rates, depending on which market you go to, is somewhere between 70 and 90%. 70%, the lower end, is probably more like a London, lots of long commutes and so on and so on. But, you know, German offices or Switzerland or Austria, I think office occupancy is definitely sort of around 90%. So yeah, people are back in the office. There's a cultural element as well, fine. But, you know, in a European city, you have European cities are fairly dense compared to a North American city. We have good public infrastructure. You know, we live sometimes, you know, in flats. We don't necessarily have, you know, the space for an extra office room. Whereas in the US, you know, why would you go to sort of an outdated office block that is sort of next to the interstate on the fringe of Wichita? Everything around you is just other office buildings. There's no cafe. You know, there's no sort of like evening entertainment. You need to drive, so you're going to pay for gas and you're going to be stuck in traffic. Whereas at home, you know, you live in a big house, stereotypes, okay, fine, you know, and San Francisco, New York, different stories, you know, but on large, you know, you see sort of why people in the US might be more inclined to sort of not go to the office. But I think for European offices, it's clearly about sort of the quality and the location. If you look at vacancy rates for market overall and you go into the CBD locations, vacancy is very low. if you look at grades in terms of like quality of office space, like the high-end grade A space, that sort of availability is very, very small. When you think about it, everybody's going around saying like, we want ESG compliant offices from a tenant side, from a lending side, from an investment side, and you look at what is in the pipeline, I said after this year, the pipeline will drop. Then you can see a huge gap in the market between sort of demand for this high quality space and what actually will be available in the market. So there's a lot of talk about brown to green strategies, and I think they are very, very, they have definitely a reason to be there. So when people say like, the office is dead, I always go like, where did you get this from? Like I can see that there is.
I heard it in the office.
Well, yeah.
To pick up on one of those points, my role is to invest in the office sector, so I'm incredibly positive, and I agree with all those comments. But it is market dependent. I think London has shown that there's been a return to office. A lot of rhetoric coming out of the big corporates is around analysing turnstile data, increasing collaboration, enforcing quite strict policies. But I think in part that is linked to labour market dynamics, because Dublin is a market we invest in where the return to office hasn't been that great, actually. We have some large-scale assets in Dublin where office occupancy levels are fairly low. And I think that perhaps is in part due to the reliance on the tech sector for a lot of the occupational demand. And at a time where the tech companies were all growing during COVID and arguably now right-sizing if you're being positive, downsizing if you're being negative. But there wasn't the pressure on employees to come into the office. They were very well equipped with work-from-home environments during the pandemic. And the labour market dynamics for employees were pretty strong. So if a Meta or a Google came out with very strict policies encouraging return to the office, employees could stick two fingers up and go and work for LinkedIn or for Apple. And perhaps they don't have that choice anymore. So Dublin has been very slow. I think that is changing. Certainly in a London context, the return to the office has been great. And wonderful to see at the top of your chart, Oliver, on one of the slides, that you have London city rental growth as being right up there as a stellar performer, because we, as a house at Union Investment, do have high conviction in London particularly, and we're very focused on that top-tier product where ESG criteria are met. Our funds predominantly are Article 8 funds, so requiring EU taxonomy compliance. The challenge on the investment side is just trying to source these brand new, all singing, all dancing offices of the future, because they certainly don't really exist in abundance on the investment market. And therefore, part of our strategy going forward will be how can we create that product that we want to own for the long term? So can we get more involved in forward deals, whether it's forward funding or forward commitments, in order to own those future-proofed assets?
So that's stepping into the development side in a way in order to...
In time. I think there's enough risk out there that we don't want to necessarily dive straight into development, but part of the thesis of opening our London office 2 years ago was that we would start to build our own product, manage the core. We see that as a great route to accessing this office stock of the future. And in trying to get a handle on the various sustainability metrics, we've analysed a number of investment deals of late where buildings are 2-3 years old, but they would have been designed and planned at a point in time where sustainability metrics weren't necessarily at the forefront of thinking, and already perhaps are outdated, thinking about CREM path analysis, which is a key tool for us when we're analysing the opportunity. We just want to make sure we're on the right side of that, particularly if we have this long-term horizon.
Okay, good. I'm going to come to the sustainability part in a minute, but Rogier, I know you wanted to pick that up, and I'm reminded that the Dutch office market, I think it was about 10 years ago, Josh Short was on a panel and just described it as under-demolished at the time, was his phrase, but there was quite a lot of activity.
There was a lot of conversion as well to apartment buildings, and that helped a lot, and a lot has been demolished in the meanwhile. One word in London, I've been here, I'm not here every month. It's busier on the streets these days. Despite the poor weather, there's more activity and the atmosphere is better. And I'm here now for almost 24 hours, and no one has mentioned Brexit. That also seems is not an issue anymore. So in general, things tend to be a bit...
It's just PTSD kicking in, I think.
might happen as well. No, in general, on the office market, I mean, the office market will be smaller in the future. We have to face that. Prime rents are increasing in London, probably in Amsterdam for sure. A Paris-proof building is probably 50% more expensive to build, to lease out, than you can get in a secondary office market. That means that it doesn't really pay off to invest in a Paris-proof building in a secondary office market unless you can get a higher rent. Tenants will accept that, but for less square meters. You can actually already see that every tenant in the loan book that we have is actually reducing their spaces and giving back floors to their landlord. So they stay, but with less square meters and with more incentives in terms of investments in the properties themselves. So that means that actually tenants are using less square meters. Square meters are getting more expensive, so it's more challenging to add those. And basically, so again, like the previous crisis, I'm repeating that too often, I notice. There will be more demolishment and there will be more conversion, but now probably not from office to resi, but more from brown to green. And that is the transformation that we will now be going through.
There's one last element, and then I'll leave it with the offices. But when you look in the news and you see sort of like what kind of companies are announcing sort of these plans where you have to mandatory be in the office, and that say like we're going to cut sort of like our office space by half. These are all usually major corporations, and I think the reason is because they can do that. If you look at the office market, I mean, yes, they are sort of like, I don't want to put a percentage on it, but they are a large part of the market. But there's also a large part of the market, of what you would call small to medium enterprises, And for those companies, I think, either they are already back in the office, or, if of a law firm with 50 people working there, 5 people decide, to work from home on that day, the effect on the office, and the space use is minimal. And if you think about, and this building is a good example as well, today is Thursday, so if you go up to the employee restaurant today, it will be busy. If you come tomorrow, not so busy. But if you come on a Tuesday, Wednesday, Thursday, it's hard to find a meeting room because then people are back in the office, they're using it as a place to meet people, to have their conversations, and then yes, Monday, Friday, they might work more from home to do other things. Because if you say, we're going to reduce sort of the time spent in the office by 20%, it doesn't mean that you can cut space by 20%, right? Because you still have sort of peak occupancy, and maybe you just configure the office differently. You will need probably more meeting space, formal and informal.
Sure.
And it was interesting actually in Warsaw last week that the much more, a very positive view actually coming from there, but also on the office because people hadn't really stopped going to the office in a way. So it was quite a different atmosphere. And I'd be interested to revisit both the French and German markets, which we'll do over the next month or so, because definitely it was a positive view in Paris, on the outlook, a negative view in Frankfurt, and a positive view in Warsaw. And actually this is relatively positive, and I buy the cautious optimism, Miles, that you mentioned before. I just very quickly want to talk about retail, because nobody really mentions it except for the past 6 months when it's come up a couple of times with people seeing it as an opportunity. And I could see on your slides there that when you put in where the opportunity was, retail was there, shopping centres in Europe. So is it finally the year when retail will bounce back?
I think retail obviously at the moment is under severe pressure because retailers basically get beaten from two sides. On the one side, you have like a slowing economy, less consumer spending. On the other side, they get hit by higher energy prices, higher staff costs and so on. So retailers remain, I think, a lot under pressure. When you think about retail real estate, though, I mean, if you look at shopping centers and the journey that you see in pricing for some shopping centers, I mean, you do start to wonder, is this the floor now? And at that point, a well-run shopping center with, tenants with high covenant, why not? The other things that sort of performed well, and there are lots of examples which are also a little bit more sort of e-commerce resilient. They are sort of, your supermarkets and your retail warehouses, your retail parks. I think on these retail parks, the rents are sort of like fairly affordable for a lot of retailers. And you see a couple of like retailers that you would usually find on the high street, going out to those retail parks, coffee shops, fairly normal now to have on a retail park. So I think in retail there is still an opportunity, but you need to be very, very selective and, again, sort of macro trends like urbanization, population growth in the catchment area, those kind of things are sort of the key drivers. But again, I think I do sometimes wonder, with the correction we've seen for parts of the shopping center market, is this an opportunity? Could this be an interesting time? If you think there will be a cyclical upturn, inflation pressures going away, we have seen a lot of retailer insolvencies as well. So, there's been a clear out a little bit as well.
I think too often there's a blanket view because what is retail? Is it supermarkets, high street retail, shopping centres? So it's very important to differentiate because it's so easy just to come out with this blanket view that retail has all these inherent problems. But if stock selection is strong, if you're looking at grocery, limited income, whatever it might be, then I think there are definite opportunities, particularly because the pricing movement has been so significant. And core locations, good quality, ESG-proofed assets, I think definitely still serve a place.
Okay, good. Rogier, go ahead.
Yeah, we're kind of avoiding the word shopping center in the meanwhile because there's so much different within the asset class. That's one thing. And it's really, it has to be a place where you have to be or where you want to be, and otherwise it's not working. So we are still financing retail, and that includes functioning high streets and a convenience shopping center where you indeed have to be. But everything which can easily be replaced by online shopping is not, to be honest, not worth investing in. And another thing, we have quite reliable footfall numbers available from locators, and they clearly show falling footfall since, I think, 20 years or so. So if you add spending power to that, combined with increasing rents, on the long term also slightly increasing energy costs, then the perspective for retail in general could be questionable.
Okay, good. I just wanted to pick up a little bit on the ESG side, which has been running through this a lot and was obviously one of the kind of key trends in the presentation there, Ollie. But what I'd be interested to get is, I suppose, how that's influencing your business on a practical side as well. What does that mean? So, for you, Mathilde, obviously, there's also an element of social impact and those kinds of things coming through. And again, there's how, what energy are we using? Are we going to have to move to green energy for everything to be on the right CRREM pathway? What does that mean? So I guess it would be interesting just to get the sort of practical things that you're having to think about now, and how it's influencing the businesses.
Yeah, definitely. So Octopus is a B Corp, so it's very much in the DNA. And our CEO, he likes to describe us as an activist investor. So it's very much at the center of of our thinking, and it's definitely not just words. So one of the key examples is we are the largest owner of care home in the UK. We have 1 billion under management, which is around 100 care home. And the fund is one of the best rating in terms of GRESB. There is obviously green clauses in all of the leases. People are very, very much involved, and apparently some of the tenants are saying a little bit too details, but it's quite important. But most importantly, on that front, we have 2 nurses that work for us. And visit the care home on a regular basis. To our knowledge, there is no other investor that have that on the care home side, to show you how important it is. We also have financed a couple of research to show whether the senior living has a beneficial impact on health. And it turns out if you live in a senior living, most of us will not have to go to a care home. So 95% of the people that will live in the senior housing won't have to go to the care home. And in a care home, your life expectancy is 18 months. And it's not usually like where you would like to decide where is your end of life. Even though it's very much a need place, and that's something that we believe in. So we have a major social impact in there, and it reduces the number of time, like you don't have to go to a care home, but also reduce loneliness. It reduces also the number of visits to the GP, because you have people checking in with you all the time. So that's quite important. In terms of the sustainability part, that's something we take into account in every of our building in terms of BREEAM. We have a target of doing BREEAM excellent. However, when you take over land is subject to planning, sometimes you have to make a little bit of consideration. On the rental side, at the end, or next investor, like the next potential person buying the asset is going to be a core investor. And like Michael has mentioned, the ESG constraints are going up and up and up. So from a liquidity perspective, we have to take that into account. It's just it's not something that we can disregard. And from a lender perspective, we have a partnership with Home England, and we offer lower rates when or lower exit fees, lower interest rates, if the opportunity that is being financed is more green.
It's coming right through the value chain, isn't it? Because it's the requirements and expectations of end users, the occupiers, what the investors need to satisfy and fulfill in terms of their criteria. And then in the lending world as well, with sustainability-linked loans, I think we're now starting to come to a place though, where we're not thinking of ESG in isolation as a tick box within an investment committee. What ESG badges might there be? But it's just an inherent expectation that will be incorporated into everything that we do. Because if we are looking at that longer term horizon, it's very clear that we need to be on the front foot, and we need to make sure that all of our assets within the portfolio are going to be decarbonised sufficiently, that all assets we want to invest into follow the right ESG themes. And we get very focused on the E element, I think, in part because in some sectors the S and the G are maybe slightly harder to qualify and quantify. But it's absolutely paramount, and I think very soon we'll stop talking about it as such an isolated theme, because it would just be incorporated into all of the practices that we universally adopt.
Yeah, it's quite an interesting one, just because I've been doing an interview which will be in the next issue, in the March issue of Impact, and that has a little piece about it where it's, there's a view that it's beginning to move away just purely from the E and actually becoming part of governance in a way, that it's shifting towards that side of it. But interesting to get your view, because obviously there's a lot of electrification in logistics, potentially therefore a lot of power and those kinds of things.
Yeah, power is a separate point, but it is absolutely crucial. But on the ESG point, I agree entirely with what Miles is saying. It's now integrated at all levels, coming from every direction, you say. Lender, investor, occupier. And the good thing is, when you're a developer, you can specify the ESG credentials, and that's something that I will be looking to do in the schemes that I will be funding, is to really push forward ahead of even today's standards, to make really to future-proof these assets. And it's all of this stuff. There's so many different angles to it. The social piece is another. Making these buildings decent places to work, tying in with local communities, and all of this type of thing. Because obviously, logistics buildings, not everybody wants them on their doorstep in terms of truck movements, and they don't look the most beautiful. And so it is bringing all of that together. It's all to do with community interaction. There is governance as well, definitely, as well as the sort of the slightly easiest bit to grasp, which is the energy and environmental pieces. And so yes, it's coming from all angles, and is becoming very much the norm, and it's much less of this sort of, as you say, Miles, sort of everyone sort of going, oh my goodness, what are we doing about ESG? It's everywhere.
Okay, good. I wanted to just check if there's any questions, any thoughts anybody's got. Do raise your hand, stand up, shout out, whatever is. Yes, Tristan, go ahead.
One question overall is the refinancing. I think end of last year we were talking about the opportunities being offered by refinancing coming through, properties that were bought 4 or 5 years ago, and as to whether that was going to create more problems for those people who needed to find extra equity because they were going to find that lower LTVs and everything else like that. Do we think going forward into 2024 there's going to be more opportunities coming through for buyers from forced sellers on that sort of a basis?
Okay, good. Hold that thought for a second. Does anybody else have one? And then we'll take those. Yeah, John, go ahead. Oh, somebody's just rushing to you. Look, there we are. The excitement of it all.
There's quite a bit of M&A activity in the UK listed real estate market starting to seep out over the last couple of weeks. Should that be seen as a lead indicator as to what's sort of going to happen in the broader underlying market?
Okay, good. Any others? And we'll take them all at the same time. Yeah, go ahead. Yeah.
It would be good to get some comments about development finance. I mean, it has been so difficult to stack up a student housing or build to rent. I see Miles in the space. It'll be good to get some comments how you are seeing the market and development finance on forward funding or forward commit that you mentioned.
Okay, great. Let's take those. Let's take those three. Anybody can pick them up. So we had refinancing opportunities and whether that was going to bring more opportunities in the market from forced sellers. M&A activity, is that, are we going to see more of that? Is that a precursor to what we might see in the market? And also development finance. So anybody want to start on any of them?
I can start with the first one if you want.
Okay.
Want me to, because it actually comes back to the funding gap. If there is an equity gap, then and the equity is not available, people might have to sell. So yes, it will. I mean, there is equity available, and either that equity is at the buyer or the seller, but it will trigger, it will restart the market.
I would agree. My question is, what kind of assets will then be coming to the market? Because these might be assets where then again, the lenders or are not willing to roll over the loan or provide a new loan, and are those assets then assets you want to really buy? If the discount is big enough, maybe there is an opportunity. I mean, as I say, in general, I think there will be more opportunities coming from distressed sale. Question is, is the discount big enough, depending on what kind of asset you will actually get or you'll actually have.
Of course, as always, it depends. Basically, we approach it as it is a new loan, and of course, we try to team up with our clients, but we have a responsibility, and we will deal with it the way we deal with a new loan as well.
I think there will definitely be opportunity there. In summary, the phrase "extend and pretend" was often used last year, and that seems to be being pushed away slightly this year. But we've already seen, speaking from a London office context, quite a few distressed sales now. Those in Canary Wharf are grabbing a lot of attention. But I think there will be that equity gap, and there will inevitably be opportunity. But to Oliver's point, what sort of asset will that be, and is that one that a core investor really wants to buy?
We have seen distressed assets in the market, and some driven by too high lending, I would say. And we have benefit of that on some of the land that we have bought. And I think we'll see more of it, because I think, especially on the operational side, people have been under a lot of pressure. To Miles' point, I don't think this is necessarily directly core, but from a value add perspective, and you have the opportunity to reposition the asset, whether it's taking over the operation or whether it's doing a refurbishment. But yes, there is a lot of pressure in the market at the moment, and we're seeing the pricing coming down quite significantly.
Okay, good. And development finance, how are we seeing that?
Happy to take that one in terms of residential, because in the multifamily BTR sector, there are very few stabilised assets available. So if investors want to get into the living sector, into multifamily BTR, then often the only really viable way to do that is to get involved with development. But development finance is expensive, and it's therefore quite difficult to make the numbers stack, which I think is why we've seen so many different projects stall, particularly with various legislation that's coming through, a focus on the Building Safety Act, the feature of requiring 2 stair cores for buildings above a certain height. So there are some very difficult dynamics with the development market, which I think is why there has been such constrained supply coming through, and development finance is a very key part of that. It's expensive, and numbers often don't stack up.
Yeah.
On the logistics side, those sort of complexities aren't really there in terms of, and therefore we have, I think that it's safe to say that generally speaking, there has been development finance available. Yes, of course it's got more expensive, it's been more volatile, and people are now being more positive, and therefore it's becoming a bit easier. But it's still there in the logistics sector, yeah.
Okay, good. Yeah, go ahead.
Yeah, what we see currently see in RISI developments, especially, that in 4 of the 5 cases the investment is higher than the market value at completion, and that kills a lot of development loans. Otherwise, it's available.
And I guess, John, what you were talking about in terms of the M&A activity, that there's obviously then acquisitions going on in the market. It's just not necessarily for single assets or portfolios. And is that a sign of increased activity potentially coming? John, if I've got that right.
Are you thinking only from the listed side, John, or are you thinking more broadly? Yeah. I think the motivation for the listed sector activity we've seen, as you say, in the last couple of weeks is this whole thing about having 2 smaller REITs or listed companies is very troublesome. They don't have the liquidity in the shares. They need more liquidity. They need more critical mass to attract more investors, etc., which is very much a listed issue in itself. I don't disagree that I think that, and ultimately in the 2 that are going on at the moment, there's this whole sort of pricing issue and lots of bickering about that, which is obviously what you'd expect. And I've no doubt that we'll see the same. Whether we'll see big portfolios and that type of thing, trading, potentially, yes. So yes, probably is a sort of harbinger of what's going to happen.
Okay, good. Any other questions? Then I've got one last one, which is if we're looking at positive opportunities, which is the opportunities part of it, where do we see them? 30 seconds each. Let's start with you, Rogier. Where would you be desperate to lend, let's say?
Affordable housing for sure. There's a clear lack everywhere, all over Europe. It's challenging to make it work. We issue social bonds, and so in fact we need social housing in order to issue those social bonds. And so that is exactly what we are looking for these days.
Okay, and affordable housing and interest when particularly for the Netherlands, but also across the UK and the rest of Europe. Nick.
I think 2 parts to this. One, long term, the super core logistics markets in Europe, we will continue to see strong rental growth for a long time to come, and land supply will continue to contract. Short term, I think that more peripheral markets around Europe, where there's very, very limited high quality logistics space, are real opportunities, because occupiers want and need high quality space, and if it's not there, there is an opportunity for a developer. And actually, Panattoni is selling a bit here. They've just set up in India, which is a very similar type of approach. Obviously huge economy, etc., but there's very, very little high quality infrastructure in terms of not only roads but also logistics buildings. It's the same effect, if you like.
Okay, good.
I think that the living sectors offer huge opportunity. It's still very behind the curve in Europe versus the US, for example. So the nascent, immature nature of the markets, I think, will offer a fair degree of upside. And a number of core funds and funds across the market have typically deferred to office and retail as their primary asset classes. So there's a huge diversification play there as well. And then to beat the drum for UK residential, an unregulated market, which provides that natural hedge against inflation. So particularly trying to capture the theme of rental growth, there could be huge income performance to come. So for me, it would be the residential sector and all of the subsets, such as senior living, Mathilde.
So yeah, no, I think like like being fair, like I see like the living sector generally speaking picking up. I think is different stage at different countries. Spain is probably like the one where we see like the most opportunities for us in the senior living sector, but also on the affordable housing side. I think there is a lot of opportunities in Denmark as well, even though it's a small market. And I'm still hoping for a correction in Germany, but that's more hope than anything else. And I think definitely if I had my own money, I would happily like invest in PRS and BTR in Milan, because like the fundamentals are very, very strong there. There is a story for London in terms of the BTR and senior living as well on the rental side. And I think we see like opportunities, especially with the recovery from the UK.
Great, Oliver.
Not to repeat, but yeah, of course, living in all the subsectors, I think there's a huge sort of amount of very interesting opportunities and models in there. Probably a little bit more on the operational side. If you know what you're doing. We've been looking a little bit more into hotels, but also because we have a hotels team which is very hands-on. So they're not just buying the building and renting it out. They go in, they change the structure, they put a new general manager in, they cut the costs. It's really sort of hands-on. Logistics, I think has a great future. So anything that sort of works along sort of more long-term trends, like demographics, like urbanization, changes in supply chains, and how the global economy and global trade works, and definitely brown to green. I think there will be a huge lack of this kind of high quality space that tenants are after and are willing to pay the rent for in the market coming.
Okay, great. Thank you very much, everybody. Thank you also for your questions and joining us here. And thank you to Schroders again for hosting. Teas and coffees will be available next door. So look forward to chatting with everybody afterwards. And I'm going to give you a round of applause for being here, which will also be for the speakers. Thank you very much, everybody.